to SB Talks. Today is Thursday, October 12th, and I'm once again joined by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, Nick, unfortunately, there's only one place to start our conversation today, and that is the unfolding situation in Israel. Obviously, a horrific humanitarian situation there. But also, from an investment perspective, it's probably worth reflecting on how the markets responded to that. And obviously, we had the Ukraine situation that kicked off earlier last year, and there was a very severe market response. How has it differed from what we saw at that time?
Yeah, it's been a fairly benign response, really. The main impact we've seen is a rise in the crude oil price. So Brent crude was up about $4 a barrel from 84 to 88, so not a huge increase. But that followed it having fallen about $11 a barrel the prior week, so it was just a bit of a rebound from some prior losses. We saw gold up about 1.5%. It's a safe haven asset, so often you get people moving to something like gold if they're worried about geopolitical events. US 10-year bond yields, another safe haven asset. They did quite well. The yield came down from 480 to about 465. And equity markets actually were up. So it seems like the market's really saying it's not going to have a major impact. I think there's still quite a lot of uncertainty as to maybe what the longer term impact might be, for example, through sanctions or tightening of sanctions on Iranian oil, and whether that would cause a further spike in the oil price.
We'll talk to that one a little bit further, because technically Iranian oil should not be hitting the world market. How does that play out in terms of what's actually occurring currently and what they may choose to do there?
Yeah, so there are sanctions on Iran, following the breakdown of the nuclear agreement that they had a few years ago when Donald Trump came to power. But they've been quietly producing oil and selling it on world markets, possibly to countries like China and India at a big discount to spot prices. And they'd been increasing their production from about, I think it was 250,000 barrels a day to almost 2 million. And particularly after they did that recent deal with the US, where $6 billion of money that was locked up was allowed for humanitarian purposes in return for a hostage swap.
So dare I say the West is turning a moderate blind eye to what happens there just because of the pressure on energy prices, full stop.
Yeah, well, that's right. I mean, it's offsetting to some degree the production cuts from Russia and Saudi Arabia. So they're turning a blind eye.
But overall, as you say there, you talk about a serious flashpoint in the Middle East, and you'd expect, bond yields are going to have a significant adjustment. We'd expect a significant spike in gold. It's really quite moderated, given the events that are, I guess, still unfolding in front of us. Yeah,
that's right. Still fairly early days, I would imagine.
Now, events in the Middle East aside, the other most notable activity on world markets in recent weeks has been the bond yields, and we've seen a very sudden spike in longer-term bond yields and to a degree shorter-term lesser degree shorter-term bond yields. What's behind that?
Yeah, so it's been a case of, particularly over the last quarter, markets really, reacting to the good economic news, the economic resilience. I think I've written previously about good news being bad news, good news about the economy being bad news for financial markets. So
let me just touch on that one again, because it is a good one to remind. It's not a new story. It's been happening since the GFC, where we've had, at that time, any sort of bad economic news was cheered on by markets because it meant, the central banks were likely to keep interest rates at zero for longer and were likely to increase their quantitative easing programs. Now, a decade later or so, the market cheers the bad news because they assume interest rates are likely to possibly get cut sooner, or converse to that, if the economic news is good and the economies are sound, that means rates are higher for longer. And that's probably the way that the trend in sentiment has been in the last month.
Yeah, that's right. And I think also it was, probably helped by the Fed's September meeting, where they pared back the expected rate cuts. So the Fed officials provide these, what they call dot plots, of where they see rates at the end of this year, the end of 2024 and the end of 2025. And they're still saying they think there'll be one more rate hike this year, this calendar year, and fewer rate hikes next year. and the year after.
So how has that changed? So we've now sort of seen rate cuts sort of priced in, but not until late next year. How does that differ from where it might have been a few months ago?
Yeah, so they're quite material rate cuts priced for next year, and now the market's really pared those back. So I think the futures market has the cash rate at about 4.8, and that compared to about 3% after SVB.
Right.
So there's quite a big increase in where rates are going to be at the end of 2024.
So a realization for the bond markets and also the equity markets that where rates are at right now are probably where they're likely to stay for a sustained period of time.
Yeah, it's definitely, there's a higher for longer expectation. There's also, people saying, well, rate rises in the past haven't really had much of an effect, particularly on the unemployment rate and consumer spending in the US. And so maybe the neutral rate of interest, or what they call R star, so the level of interest rates that neither speeds up the economy nor slows it down, that might be higher than what the Fed had initially signalled. So that Fed officials, also in that dot plot chart, say they think that the long-run neutral rate is around 2.5%, and so interest rates at close to 5.5% would be very restrictive, but that certainly hasn't been the case. So maybe interest rates can be higher for longer.
And the neutral rate is certainly not as low as they possibly currently assume it to be or estimate it to be.
Yeah. I mean, there's some other technical factors that have also influenced bond yields. So, for example, the fiscal picture in the United States is quite weak. They've got budget deficits of about 5.5% to 6% each year. And as bond yields go higher, their interest bill goes higher. So there's certainly a lot of issuance coming.
Yeah, so significant supply of bonds onto the market there, and potential slight changes in the bond buying dynamics as well with the...
Well, that's right. Yeah, so we had central banks as essentially price-insensitive buyers of bonds for many years. We had the Chinese and Japanese, building up foreign currency reserves and buying treasury bonds. And those sort of forces have gone into reverse. Central banks are sort of certainly not buying bonds, and in some cases they're selling them, and potentially reserve managers are also selling treasury bonds.
So you're almost seeing a return of more normal dynamics to that bond market, and therefore the price has been set at probably more commercial market rates than it has been for a decade plus.
And that's right. And bonds have been very volatile over the past couple of years, and I think investors want to be compensated for the risk there with higher yields. So there's all these forces at work on the bond market.
But broadly, also then, a US economy that's showing a reasonable degree of resilience. And where do you sit on the narrow path back to soft landing? Is it still there, or is that...
Well, based on the labour market data we've got over the last couple of weeks, it's certainly there. So we had the job openings report showing the number of vacant jobs in the US had actually gone up from about 8.8 million to 9.6 million. So that had been falling, but that seems to have jumped in the last month. And the number of new jobs created in September was almost double what economists had expected, right. 336,000 jobs. They only need 100,000 jobs to keep the unemployment rate steady based on population growth. So 336 is a very strong result. So it shows the economy is still creating jobs. The good news out of those reports was that wages continue to kind of edge down. So that is good for the inflation picture.
Yep.
So you would have to say they're still on that path to the soft landing at the moment.
And as you said, good news is potentially bad news then for the bond market in terms of rates being higher for longer. And equity markets have certainly responded to that somewhat over recent weeks as well.
Yeah, I think equity markets have been more sensitive to the bond yield story than they have to the better economic outlook story. So
possibly a bit of stock taking after a pretty strong run in US equities in particular early in 2023.
Yeah, and with bonds, yielding, in the high fours, just makes equities look less attractive on a relative basis.
Now, I might turn closer to home if I can. A huge amount of, let's call it fear, building up in terms of the fixed rate mortgage cliff here in Australia. And we know that is a huge number of fixed rate mortgages that were taken out in that sort of post-COVID era at fantastic interest rates, 2%. And they are beginning to come to the end of theirs, and those loans are converting across into floating rate loans, which sees the rate potentially jump from 2 to 6.5 or 7, depending on the circumstances of the loan. Well, we had the RBA Financial Stability Review released last Friday, and a lot of eyes on that one to say, well, what is the health of the Australian household, and what's your take on what we saw in that review?
So the RBA's conclusion was that households are well placed to manage higher interest rates and higher inflation. They painted a picture of a financial system that's, in pretty good shape still. They noted that those borrowers that have already rolled over from fixed rate loans to variable rate loans have really not suffered any additional stress relative to the cohort of those that were already on variable rate loans. They note that a lot of households are still sitting on elevated savings.
So those COVID savings are still there in the bank, helping prop up the economy?
They are. They're there in both the pockets of those with variable loans and fixed rate loans. So they've painted a picture of an economy that's pretty resilient. The number of borrowers that are having where their income is less than their essential spending and mortgage payments is only 0.5%.
Right.
So still quite a small cohort. And sorry, I should add that they also have savings. So they're the sort of no savings, So they're the...
Right. So they're the ones that have already, unfortunately, depleted their savings, and they're now at a level where unfortunately, their income can't quite cover their essentials, but still a fairly small portion.
And they estimate if interest rates would go up another 50 basis points, that number would go from 0.5% to 0.7%.
Right.
So
still not a dramatic rise there. Yes, in quantum, it is quite a leap, but it's not jumping up to a big portion of the population or the households.
That's right.
Mm. And we probably have seen some anecdotal evidence there as well, as people are possibly approaching closer to that situation, given the property market has still remained quite resilient, that they are choosing to take that path.
There's anecdotes that people are selling their house before they get into serious stress or get really fall behind on their mortgage.
But again, I guess it's a picture that's still unfolding in front of us, but the Australian economy the Australian household continues to show reasonable resilience, and that's a good news story, as it should be a good news story. So we follow the narrative. What does that mean in terms of our outlook, Michelle? We'll look in the interest rate picture in Australia. We're pricing in close to being at full interest rates, perhaps another one more rise?
Yeah, so there's about 10 basis points priced in between now and I think it's March of next year. So, almost a 50% chance of another rate rise. I think a lot will depend on where we get, where the next inflation number comes out at, which we get at the end of October, and potentially where the next wages number comes out. We get that in early November. But certainly the RBA, having paused since June to see how all of this unfolds, particularly with the mortgage cliff, they can now be in a fairly confident position that there's resilience in that household sector, and if they did need to put through another 0.5% rise or 0.25% rise, that it wouldn't necessarily tip a lot of people into mortgage stress.
So if they felt the need to pull up the brake a little bit further to push against any inflationary pressure still coming through, the economy probably can take it. Watch this space. And given, since the last time we sat down and talked portfolios, we've had events in the Middle East, we've had a lot of activity on the bond markets. Has that changed anything in terms of how you see portfolio positioning currently, your mix of assets between fixed income, equities, alternatives?
Yeah, so we've spoken on the podcast previously that as we got closer to the end of the rate hike cycle, we'd be looking to gradually unwind that underweight to fixed income. And that's what we've done this month. We've actually moved to a neutral position in fixed interest, and we've added that interest rate duration back into the portfolio. We view that the risks to bond yields are more two-sided now. They're more balanced, whereas before they were pretty asymmetric. Long-term bond yields could still rise, but equally, if we hit a soft patch, then they could fall. And there's a few things on the horizon, particularly in the US with the end of the student loan moratorium. the higher bond yields, the higher fuel costs because of the higher oil price, and also potential another government shutdown that could see bonds, fall, as we've seen in the last few days.
Yes, well, I guess there probably are a few more risks onto the horizon, particularly with the Middle East situation. So what you've essentially done is we've taken the opportunity with the rise in yields to put a bit more insurance back into portfolios, and it's been a quite well-timed move. So well done on that one. And thank you very much, Nick. Thanks once again to all our listeners. Take care.